2014 was an interesting year for this industry because in many ways it was the start of the first cohort of players in this space. Whether it was a neo-growth, capital float, lending card, Zest Money, Indify, India Lens, a lot of the players that you see today actually began around the 2013 to 2015 timeline. And back then, I think most of us were greeted with a fair amount of skepticism. 5 years is a long time for some businesses, but a very short time for lending. But it's a good checkpoint on the way to look in the rearview mirror and actually look at some of those assumptions that both investors and entrepreneurs made when starting on this journey. And there's 6 fundamental questions that I think most of us in this room and in this industry had to take a view on when we started. And question 1 was very simple. If you look at the last 5 years, there's been an unprecedented amount of growth in infrastructural elements for digital lending in India. Okay. Holy grail for digital lending has always been the one-click loan. Over the last 5 years, the consumer piece, I think, is without question. Whether you look at 350 million users of smartphones or the staggering 260 million active users on WhatsApp, there is little debate today that the target market on the consumer side is online. Overall, the reality has been that turning online SMEs into online transacting SMEs and then borrowing SMEs has been an area of challenge. And the response that a lot of players have taken here is assisted flows. The process may begin online but may end offline. It may go offline for a bit and then come back online. Despite this, SME lending digitally in the space has been robust. But to a certain extent, there has been a feet-on-street element to a lot of the models that we see today. But one area where the Indian market has actually far outperformed its peers is something that perhaps none of us expected when we started this journey. And that is product innovation. Today, if you actually look across consumer and SME lending spaces, the sheer number of specialized, bespoke, innovative products in the lending space is mind-boggling. On the consumer side, you of course have personal loans, but you have digital cards, online EMI, offline EMI, salary advances, healthcare loans, education loans, travel loans. By contrast, the majority of US consumer digital lending in the first 5 years was all personal loans. If you look on the SME side, there's an equal amount of innovation. Online seller finance, merchant cash advance, bill discounting, supply chain, pay later for SMEs, loans for workforces, loans for schools. It's a mind-boggling array of products. And far ahead of, I think, any peer economy at the 5-year checkpoint. You've got not 1, not 2, but actually 5 distinct models of how digital lending players are funding their loans. On the one extreme, you've got the pure balance sheet, co-lending, securitization or direct assignment, powered by a bank or an NBFC, which is essentially the balance sheet of the bank on the back end, and P2P. Almost every player today is some combination of these. You have players who are part balance sheet, part co-lending, people who started out being powered by a bank or an NBFC, but now getting a balance sheet, folks who are doing a combination of balance sheet, co-lending, and securitization. And the reason for this is actually a set of peculiar constraints in the Indian market. The first was a lack of sophistication in the capital markets. A lot of US players simply originated on Wednesday and sold the loan down on Thursday. The second was the fact that wholesale lenders, banks, were much keener to take direct exposure to customers as opposed to wholesale risk on young, loss-making platforms. And the third was that because a lot of digital lending in India had to be to thin file and new to credit populations, you had to be full stack to be able to serve the customer, and you had to take risk to be able to actually figure out how to underwrite those models. And so through a sort of a constrained process of innovation, India actually ended up being a pioneer in the skin in the game hybrid model that today the rest of the world is all coming to. No discussion about funding is complete without reflecting on the interesting macro environment that we've been in for the last 6 to 12 months. And to some extent, I think this has actually been a moment of reckoning for the industry. Is it resilient fundamentally, or are there sources of vulnerability that could be harbingers of future trouble? And I'd like to, just for your consideration, share a few interesting statistics that at least makes me feel otherwise. The first is this. ALM is a very hot topic today, given the ongoing liquidity issues. But if you look at digital lending in India, because of the focus on working capital and the focus on flow-based lending, average asset durations are in the 18 to 20 month range, average liabilities in the 24 to 26 month range. So the industry, to some extent, actually has a negative ALM profile compared to a lot of the other players in the market. Another hot topic, leverage. Funnily enough, you might expect digital lending businesses to be highly levered, but the reality today is leverage ratios are in the 1 to 2.5x range, significantly below 5 to 6x ratios that the market is worried about. I'm going to take a view on this, and that is that India has actually taken a completely different direction globally. Rather than being an exception, collaboration has become the norm. And these are just a few examples of collaborations both on the asset side between big tech and fintech, and on the liability side between fintech and big finance. And the reality is today, much as we all liked to talk about this David versus Goliath story, everyone is working with everyone. And there are some unique factors about India that I believe have moved us in this direction. The first is that banks fundamentally have been far more open to retail lending than they were in the US in the wake of the crisis. And there's been a much greater history of partnerships with the MFI space and the BC models than perhaps other economies. On the tech side, a lot of big tech sectors, e-commerce, payments, are still fighting battles on their core business. And there is an understanding that ultimately lending in India requires a certain DNA around risk and collections that may be at odds with a purely growth mindset that a tech company needs to have. And so I'm going to go out on a limb there and say that actually we are going to evolve in a fundamentally different way, and collaboration versus competition is going to be the norm. The one I'd really like to focus on today is in risk, because a question that I get, and I think many of us in this room get most often, is have we actually seen a cycle? And the reality is, in that context, 5 years is a short time in this industry in particular. And while there have been kind of certain macro dislocations around demand, GST, e-commerce, etc., the reality is I think the jury is still out as to how digital risk models will withstand significant cycles in the credit economy going forward. But I'd like to leave you here with one interesting piece of evolution that I think a lot of us in this room have been seeing over the last 2 years. And that is a change from underwriting to risk. In the first 3 years of the industry, there was generally a pretty straightforward approach which went something like this. We're going to take a lot of data and we're going to build automated decisions on that. People competed over the number of thousands of data points that everyone was looking at. The idea was we will look at everything from bank statements to social media. Everything was fair game. And the idea was, how do you take a bunch of data and create a bunch of decisions? What we're seeing in the last 2 years is what I'd like to call digital lending 2.0, which really comprises of two parts. The first is a much more sophisticated approach to underwriting, really underpinned by 3 pillars. The first is high value data. So rather than going after as many data points as possible, players today are saying, what are the 4 to 5 data sources that I can go really deep on and they can stand in their own right as credit markers? SMS, mobile phone, even traditional areas like bureau, banking, etc., all fair game in this space. The second driver is modeling, right? Finally, after 5 years, I think we all have enough performance data today to build the kind of machine learning and deep learning models that a lot of businesses build teams to do. And the third is what we can call predictive lending, right? This idea of continuously underwriting the customer rather than only doing it at a point in time or a point of application. But the second part of this evolution is the realization that it's not just about underwriting. Collections is as much part of the game. Finally, the $1 million, or as we all hope, $1 billion question. Going forward, it's going to be a combination of three things. The first, linked to domestic market and the domestic growth opportunity. We'll be looking a lot more at the Indian market than at what's happening outside. The second is profitability and returns on equity. There's been a lot of wasted debate around, are you a marketplace, are you a balance sheet, are you tech, are you finance? Ultimately, it's going to come down to ROEs, ROAs, and EBITDA multiples. And finally, around resilience and strength on the asset side and on the liability side. So what I'd like to conclude with, turning the rearview mirror around, is just a few predictions for the future. It's always risky to make predictions, and lending is a risky business in itself. But I'd like to put forward for your consideration 3 trends that could reshape not just digital lending over the next few years, but the financial services sector overall. The first is credit as a service, right? Credit will be layered into every part of the digital and offline economy. And credit will no longer be about access in a few years, but about what you can actually do with that line. Second is digital risk management. Data will become a commodity, but what you do with that data will become a source of alpha. And those skills will start to become the most sought after talent in the next wave of hiring across the financial sector. And the third is what I'll call the digital unbank, right? Today, 60% of people who've taken a loan from a digital platform go back to that platform for their first insurance product. 10% of consumers who take an EMI loan end up taking their first personal loan from that platform. And so credit, right, is rapidly becoming the hook and the pathway for other products. And I believe that in the next few years, you're going to see a significant expansion of products on the liability side, insurance, wealth, etc., built around a fundamentally strong set of credit businesses that bring online the next 300 million users in India, and someday maybe even disrupt deposits. Who knows? Thank you very much.